I'm Race Kershey, and welcome to Sector Vector, the show where we dissect the U.S. equity markets to look at how the different sectors are performing. Today we're going to be looking at the S&P 500, and we'll start off by looking at the tech sell-off that has defined recent price action. The S&P 500 information technology sector is down over 11% since the start of the month, and coincidentally, recent all-time highs. Digging into the sector, we saw some pretty ferocious legs lower in big-name stocks last week. MasterCard closed down 7.5% from the high, and Microsoft has continued its sharp decline and is down over 10.23% over the same period. Consumer electronics giant Apple took an enormous hit and is down 16% on the month so far, despite the fact that the stock has consistently been one of the most highly researched companies by Wall Street pros, according to our proprietary software, Trackstar. In fact, it was the second most searched stock among professional investors and traders after electric vehicle and battery manufacturer Tesla, according to our data. Other IT-centric stocks to feature prominently in Trackstar include NVIDIA, DocuSign, Adobe, and Salesforce. Trackstar shows that over the last 30 days, NASDAQ-listed stocks dominated the search list among professional traders and investors, with 314 NASDAQ tickers featured compared to just 194 from the New York Stock Exchange's main list. Now, this is all pretty dramatic, but when we look back a few months to the start of the pandemic, there was genuine panic in the markets. Circuit breakers were being triggered several times a day, and things look pretty bleak. The current price action is tech-driven, and while nobody likes to see deep red price action, we're not in the same position that we were. So what's driven this move lower? The answer, while not straightforward, looks to be in part driven by the unmasking of Japanese financial giant Softbank as the NASDAQ whale, driving prices unsustainably higher. The company, already synonymous with dubious investments in the likes of Uber and WeWork, reportedly bought billions of dollars in call options in major tech names such as Tesla and Amazon. Big U.S. tech bets came as a surprise to investors, highlighting a shift in strategy similar to a hedge fund. The simplified assumption is that the firm may have started trading prop to make up for losses elsewhere. The unmasking of SoftBank looks to have triggered selling from other investors, including a growing trend of highly leveraged retail traders, and also momentum-based quant funds. Another sector having as bad a week as tech is energy, with a sea of red greeting potential investors. News about Saudi activism, cutting crude prices for deliveries to Asia and the US, using its pricing power to force its way to maintaining and even taking market share, has rattled the sector. The S&P energy sector has lost a whopping 47% year-to-date as of last Friday's close. Only one constituent in the sector has made headway in 2020, and that's Cabot Oil and Gas, which is up 8.51% over the year-to-date, and features regularly in our Trackstar reporting. Despite or perhaps because of the energy sector's underperformance, institutional investors and traders are still interested in the oil and gas sectors, with Whiting Petroleum, Occidental, ExxonMobil, and China Petroleum among the most researched stocks captured by Trackstar. Last week's sell-off was deep-seated and was felt across all but three S&P 500 sectors, with basic materials, industrials, and a few assorted consumer subsectors like home improvement and tobacco products. However, even these defensive sectors' gains were modest, but there are potentially early signs of an investor pivot towards these sectors. Turning to consumer-focused stocks, both the staples and discretionary sectors were down on the week. However, staples fared better than their consumer discretionary peers, with staples down by 1.5% on the month so far, compared to consumer discretionary fall of 5.58%. One thing seems to be certain, and that's in this current climate, if you're selling goods and services to the consumer, you would better have a good e-commerce offering. Research from JPMorgan Chase has highlighted this trend. In a note published on Labor Day, the bank's quant team showed that customers' online transactions using Chase debit and credit cards were up 9.3% year-to-date, but in-person transactions were down 19.7% over the same period, which is all quite logical considering the current climate. Against that background, it is interesting how the likes of MasterCard, Visa, and PayPal were hit extremely hard in last week's sell-off, but with average year-to-date gains of 32.8% between them. Perhaps they need to fall back further before they move back onto anyone's buy list. That's all we have time for this week, but before you make any investment decisions, always make sure to do your own due diligence. Safe trading!